So the big tax question is this: how do wealthy people keep their money working for them when selling their business, real estate, or other highly appreciated assets without paying hundreds of thousands to millions of dollars in tax? What if we, as business and real estate owners who have poured blood, sweat, and tears to growing our wealth, and who didn't hire expensive tax attorneys and CPAs to map out an exit strategy, knew their secrets? Instead of recreating the wheel, why can't we just model the way they deferred 30 to 50% in tax, paid off debt, funded their next business dream, and most importantly, leave a financial legacy to give to the causes we believe in most? What if their secrets weren't complicated at all, and you just need a guide who is a few steps ahead of you? That is the question, and this podcast will give you the answers. My name is Brett Swarts, and welcome to Capital Gains Tax Solutions. Welcome to the Build It to Billions podcast, where we guide successful entrepreneurs and investors on their journey from millions to billions. We believe that the key to scaling and compounding your wealth and life starts every single day with the mindset and practice of stewardship over ownership and applying billionaire biblical principles. Our ultimate goal is to help you scale and compound your wealth and life so you can give more or all of it away to help MVPs. My name is Brett Swarts, and each and every episode we're joined by the world's top entrepreneurs, millionaires, or billionaires, and they share their secrets, insights, and wisdom with us so we can all level up and make a bigger impact. I'm excited about our next guest. He's a friend of mine, and he's also an expert in all things really multi-family properties and mobile home parks, being that he invests and he brokers, and he's from the original state of California like myself. In fact, we would compete for listings back in the day for multi-family opportunities when I was still brokering out there. But he sells commercial properties, he buys investment properties, mostly in his preferred market of Tennessee these days. But he also has a team and helps people to exit most of the deals in California. And we're going to be talking today about the top mistakes that commercial real estate owners are making, and so much more. Please welcome to the show with me, Adrian Del Rio. Adrian, how are we doing?
Hey, thanks, Brett. Thanks. Love being here. Always great to see you and talk to you, man.
Yeah, great to have you on the show. And for our listeners, get to know you for the first time, maybe just give a little bit more about your background and your current focus.
Sure. My background is I grew up in the Bay Area for 18 years. Then I went to UC Davis. I played soccer at Davis, 5 years, one red shirt. I met my wife there. I lived in Roseville, California. I moved from Davis to Roseville and lived there for 20 some years. And in 2008, so going back, I actually grew up in real estate. My family still owns a roofing company via my parents, and then they slowly were investing in real estate, SFRs, then transitioned from multifamily out into industrial, multi-tenant, and commercial real estate. So growing up in high school, when I got in trouble, if I was out too late, stayed out past curfew, or just general, I would drive around with my dad, and I would be in charge of getting the units rent ready, cleaning out the units, power washing them, getting all things real estate. My dad was super influential. He loves real estate. He would jump off of a roof if a good person calls him with the deal. He'll just go. And we grew up that way. And then I moved to Roseville with my wife 22 years ago. And then shortly thereafter, in about 2015, 2016, I started investing in Tennessee. I thought the opportunities were too expensive in the Sacramento region. Little did I know that the market would take off there. In 2015-16, we started the brokerage in 2008 during the great financial crisis. We knew that banks were going to be the ultimate sellers via foreclosures, and we did foreclosures up until about 2014, until the market transitioned into a traditional market. Then in 2022, the opportunity came up where I could expand in the Nashville region with an office, and my family moved. And myself moved and have expanded in Middle Tennessee. I was very familiar with the market from owning already multifamily here. Plus have a team set up continued in California, and I go between both states and in between selling multifamily and mobile home and RV parks.
Amazing, Adrian. I love it. I love it. I love the background. I don't know if you knew, but I originally from Mission San Jose, Fremont, and I would build houses with my parents, and they had rentals, and so very similar. Like we're mostly on the job site building the things, but they had the rentals that were passive, and it's an interesting world to be built, to be brought up in the real estate world, and then Eminem, Marcus and Millichap, and then here we are. And so, it's great to we spent some time in San Diego together at the multifamily conference down there. That was awesome. And it's great to now kind of reflect based upon all of that and what we've seen over these basically 20 years that we've been in the business and some of the top mistakes that clients, and owners make. And I think let's just dive right into that, right? We're talking about, legacy and planning and being proactive and such. And so what would you say is the top mistakes you see multifamily owners, mobile home park owners that are making, right? They own these real estate. They've built this up for many years. And now they're looking at an exit or they're just looking at a legacy transfer. Like what are some of the top things that we want to touch on today?
Top things that I see when speaking with private owners. I mean, these people are what we refer to as mom and pops. They've owned other businesses and have spent the majority of their life investing in real estate, sacrificing, even sacrificing family time, weekends, times with spouse, and watching kids grow up. But they've accumulated a ton. And the biggest mistake they make is they don't have a succession plan at all. Meaning there's not even, in many cases, you'd be surprised, there's no will or trust, which means it would go through the entire, put the heirs in a position where they go through the entire probate process. In essence, you would end up paying the majority of what you worked for 30, 40, 50 years back to the government and to attorneys, with your heirs getting very little. Now, oftentimes I do see that the heirs, let's call them the heirs, the kids, the siblings, they don't participate or want to participate in the real estate because they do see how hard mom and dad worked or grandpa worked and how much they were away from the family, the time it took, and the money it cost, the financial stress. You grew up in real estate. I grew up in real estate. I was part of multiple cycles. My parents were roofers. Some years in California, as you know, it doesn't rain for years. You don't need a roof if it doesn't rain, generally. So I was through those money constraint cycles, and when the heirs see that, we're in a society now where we're all about work-life balance and more time with the family, which it is great. The way our parents operated, or mom and pops operate with pen and paper and nothing digital really, it's just not enticing to the heirs. And so when they take it over, especially with no succession plan and they haven't been involved in operations, they're going to look to, so what you work for 40 years, they're going to sell within 24 months, within 2 years.
Yeah, and it's really staggering to think about, right? And by the way, speaking with Adrian Del Rio, you can learn more about him and what he's doing by going to pcgcommercial.com, pcgcommercial.com. Yeah, it's really staggering to think about. 40 years, the 10,000 plus hours, the blood, sweat, and tears, all of it, and just an ounce of some wisdom, right, and some planning can pay dividends for the legacy, and or the opposite could just crush that momentum. I think momentum is one of the hardest things to get. It hurts the most to lose, but when it's on your side, things can go really well. So talk about just the power of planning and getting some momentum on your side, and what you found. Maybe some of the owners that are actually have a good mindset and are preparing. What are they doing?
Sure. They start with the basics. They say, we're going to do the will, put the properties into the trust, properly record them into the trust, and also have the heirs or the kids be a part of that as well. This is what we own. This is how, and then it evolves from there, because the heirs will start to ask questions in terms of, well, how much money is produced here? How much is it worth? And you at least know where it's located. So you have to start with the bare minimum of properly protecting the assets against probate. Okay. And then what I've seen as it evolves from there, the families that are able to, because speaking of momentum, you're really able to, some of the values of these estates, I mean, you'd be surprised. We refer to them as mom and pops, but at the bare minimum, they're worth $5 million. We've seen on private individuals, mom and pops, worth up to 50 million because they're located in whether Silicon Valley, New York, or other LA. You can create a lot of momentum in that when there is an event. It's not if. I think a lot of owners have a lot of hesitation because when you go to speak about your trust and the succession plans, that you're speaking about yourself in essence dying, which we all will do. We will all perish at some point. Some will perish long from now, or you can get hit by a car. The momentum is I can some family members can inherit several $1 million and set them up for legacy to either continue managing the properties and get a stepped up basis and have the cash flow, or the heirs can go on their own and purchase their own with that money as well. However, if they've never been involved in the operation, so the successful families, they get the heirs involved in operations. Hey, you're going to help me in the leasing process. Is what you refer to as a family office. You're going to be involved in rent collections and paying the expenses. These are the expenses we pay. Then since they're involved in real estate, they're likely to reinvest the money or continue on with the portfolio and figure it out with the siblings on cash flow. It's in the cases where they don't do that, where they sell off the assets, then they have several million, they have a big money event, and most of them, I don't have statistics on it, but from what I've heard is most of them end up spending that money within, it's like winning the lottery. They spend it and are broke within a few years. I mean, 40 years you worked for them, and within 3 to 5 years, it's gone.
It's unbelievable,
right?
Right?
Set up for several generations.
Right, unbelievable, right? Because the lack of planning and intentionality, and I mean, just the probate. So the first step is awareness and actually getting clear with your kids on where the money's at, what values are where the cash flow is coming from, right? The actual business itself, plus getting it out into your living trust so that it can pass seamlessly through probate versus having to go through the courts and attorneys that wasted a lot of it away. I also think it's awareness on what tax you're actually facing, right? You just mentioned $5 to $50 million, right? I think there's multiple taxes I want to touch on, and in a second you're going to touch on property tax and rent control and the biggest trap that multifamily and mobile home park owners are facing with that, especially in states like California. But before that, the other tax awareness mindset you need to be aware of is not just capital gains tax, which you can get the stepped up basis for, yes, okay? But it's also the death tax, right? And so as soon as you're above 30 million married, 15 million single, you're going to be hit with a 40% death tax. So talk about the importance of those two and understanding, that the 1031 and the stepped up basis is not always going to solve for this, and the consequences. We can kind of just bounce back and forth on this, Adrian.
Correct. Yeah, you're exactly right. So on the stepped up basis, let's just speak generally speaking, it'll wipe out the capital gains issue. However, what it doesn't wipe out is, for example, let's say I inherit a property that's worth $1 million that my parents purchased for $1 million, and now it's worth $5 million. Their property taxes are based off of their basis of $1 million. When the heirs get it, it gets reassessed ad valorem at the 5 million. So what we find commonly is with private owners, and you've known this from selling multifamily and commercial properties, is private owners, especially that have owned it long term, they say, hey, my rents are well below market. Then when you do a market survey, they're significantly below market. But as you know, there's only a certain amount of percentages you can raise rents per year. If you're dealing with multifamily, it's one time. In commercial, there's certain notices and a certain percentage. You get that stepped up, that ad valorem property tax. So your property taxes go from the current owner's $10,000, but the heirs now have to pay a $60,000 tax bill. Well, that cuts into the net operating income a ton, especially because let's say the NOI was already $60K. Well, now it just got wiped out by property taxes because owners don't keep up with the rent increases because they don't want to deal with turnover and paying for turnover costs. So that's number one, and that's often the cause of a sale where the heirs have to get together and say, we're not making enough money on this. We have to sell. For land value, structure value, especially in these high cost markets, they'll sell and they can get their money in 30, 60 days at a discounted rate. So that's
So
taxable.
what we're saying is stepped up basis has its downside, especially if the parents haven't done rent, have been only, either being generous with the tenants, but maybe they just didn't want to have to deal with the hassle, right? Just keep the tenants in there, maybe don't fix the things and keep the rents low, which has all kinds of deferred maintenance issues as well. But you just don't want the headaches. And basically you want it to be passive. And so you're just trying to okay, the tenants, the toilets, the trash, just keep them in there, and if whatever, right? It's basically not being a good steward with the property itself and making sure you're doing things. But on the flip side, the kids inherit a stepped up basis for cap gains. However, the property tax resets, the cash flows are now down. And by the way, that's not a good time to sell, right? Because now the overall valuation is going to be depressed because the NOI is pretty low. Is that a fair summary on that first one, Adrian?
That's a great summary. That's exactly what's going to happen. You'll still get, especially in these infill areas, you're going to get land and improvement values, and you still get a good price, but not nearly the price you would get if owners kept up with their rents and taking care of deferred maintenance, which is what we advise when we meet with clients or have family members. We say you got to at least keep. If you're not going to raise the rents, you have to at least make improvements, or you have the money to cover the deferred maintenance. You have to at least take care of that, because you can do it at a price much lower than the heirs will be able to do that.
Yep. Okay, keep going. Now you had a second point you were going to make there, and I kind of just jumped in there, but yeah.
The second one was the death tax, the estate tax, which I believe. What is the exemption?
So it's 15 million married now, 30 million. 30 million married now, 15 million single. That it can adjust with the changing of the guard and the administrations, but that's the federal, right? It's the federal one. So keep going on that.
Yeah. So the death tax, it will affect some. It won't affect all. However, you'd be surprised if you're talking Silicon Valley, Los Angeles, New York, how quickly just a few properties can get up to that death tax. So the IRS and the state are going to say, if you don't fall under that exemption, they're going to come and say, well, you owe us this amount of millions within 9 months.
Yep.
Which forces you, as you know, a commercial property can sell in 30 days. It could also take 6 to 7 months. Nothing's wrong with the property. It's just that's the nature of the business. But now you're into a forced discount sale scenario where instead of you may have sold one property, now you may have to sell 3 or 4 properties just to cover the tax.
Yep.
And they were maybe properties you weren't even intending on selling. I
mean, that's the biggest thing. I've talked with the owners and they're like, hey, I just want to keep it forever. And it's like, do you realize that there's property tax that's going to reset? Do you realize that if you're above this estate tax, it's the whole show Yellowstone, Kevin Costner, he's got this $1 billion piece of land in the middle of Montana. And the daughter's like, Dad, you got to sell the land. And he's like, we're never selling the land. It's in the family forever. And she's like, but Dad, if they kill you, the death tax will kick in. And then the government will take the land anyways, right? And so, or we have to sell it for a deep discount anyways. And he looks at her and goes, we're never selling the land. It's like, no, you got to face and have awareness and be honest about this tax situation. It's not going away. And to be a great steward is to move from this, you're in the warrior stage, let's say, when you're just buying your first properties and renovating and doing that. You become the king stage when you've had like your collection of all your deals worth 50 million. And then you're moving to what's called the sage stage, where you're trying to really train and coach the next generation to take over the empire. But if you don't have your tax game, it's going to be probably squandered because of the forced sale, like you said, for the timing purposes, and or the this tax. The tax is going to hit it. And so I think the big thing here is solving for these two big problems: capital gains tax and estate tax. And so, Adrian, let's talk about a solution that, I think I've introduced to you years ago, right? And I learned about it at Marcus and Millichap in 2009, and this is what we've dedicated, our practice to, which is building capital gains and really estate tax exit plans to solve for these challenges outside of the 1031 traditional way, which only really solves for cap gains tax. But even so, it typically doesn't solve for what the clients have really been truly wanting, which is that fourth quadrant, which is that truly passive income. I mean, they've been thinking and dreaming of this moment where they could actually walk away and have consistent income without the toilets, the trash, the termites, right? And as these baby boomers get older and older, time is obviously shorter for them, for all of us as we get older, but especially for the baby boomers. And they're going, I don't want to deal with the rent control laws and the tenant crazy laws with California or New York or New Jersey, these high tax states. And I actually just want to be passive, but I don't know how to get out without having to wait till I die for the stepped up basis. And so it's this chicken and the egg that they keep, wrestling with. And so let's walk through it. Your understanding of the what's called the better DST, right, the Deferred Sales Trust, and how this might be able to help people solve this challenge so that they could list a property today and sell it and really set them and their family up long term for success.
Right. So I'll refer to you on the DST to describe how it works. However, I'm a big believer of, I read a book by Mr. Perkins, and I would never, I forgot his first name, but I would never ever read a book like this until someone told me to. It's called Die with Zero. The premise being is that you do everything while you're alive, because once Adrian's 6 feet under, you can't ask me any questions. I can't help you with the estate tax or taxes. The IRS provides forms or methods of selling properties, and then what you're going to describe going into the Deferred Sales Trust and distributing funds from there in terms of gifting. There's so many different ways that you can start giving your heirs ownership while you're alive, meaning you can teach them while you're alive. And the fear that a lot of owners have with this is that they're going to outlive their money. The reality is they're not. That's not going to happen. That's not what we're promoting here. It's, if your intent is for your heirs to get what you worked hard for in terms of the gains and the equity, then we highly recommend you do it while you're alive. It's hard to talk about. That's one of the biggest obstacles we see. It's hard to talk about because you're in essence talking about your own death at this point. When you're alive, you're alive. You can enjoy it with your heirs while you're alive. I mean, everyone gets their gains. You show them how to reinvest the money into real estate or to other funds, the stock market, lending, and you get to enjoy the fruits of the labor, everyone, while you're alive.
Yes.
Instead of siblings at death, which it happens even once I get along, because of if siblings have spouses, they have kids, there's grandkids, and they all have inputs. The goal is to go to DST is to do it while you're alive.
Right.
Or use some sort of tax planning to do it while you're alive.
But no, I think your last point is good. And this is a story you were telling me, like just how many families it becomes like a curse because the wealth is so big and it's so much, and there's the lack of intentionality moves from a momentum of like everything you've done to like the kids and the grandkids and whoever else squabbling over this wealth, because parents weren't being great stewards, not just with the financial and the tax side, but stewards with the core family mission, vision, values, and the legacy of the entrepreneurship of the assets. And it's almost like, I'll leave it to them and let them figure it out. Well, that's the worst thing you can do because they don't know either. And now it becomes this conflict, right? And so what's nice, and I'll kind of just transition to the Deferred Sales Trust, what's nice about the strategy and how we set it up and the flexibility that it gives to families. And so there's one structure and one strategy where the kids can actually be the beneficiaries of the trust. And it's almost like giving all of the ownership all at once, but it only actually activates once you pass away. And so, for example, like you'd say you own a $50 million worth of apartment complexes in Sacramento, and you're listening to this, you're like, man, I really need to solve for these challenges. And yeah, I'd like to get it outside my taxable estate, and I'd like to be able to have some flexibility with the capital. Well, you can sell, defer the cap gains tax, but eliminate the estate tax, and the kids can be the beneficiaries. And then if you're married, you and your spouse will receive payments from this trust over your lifetime. You'll pay some tax, so you receive some of the payment. But when you pass and your spouse passes away, the kids inherit it estate tax free, and typically capital gains tax free as well, because you have been paying some cap gains tax over your lifetime. But the cool part is the funds can go into a diversified portfolio of real estate, of stocks, of fixed income, insurance, and you can truly get passive, like for the first time maybe ever for your real estate or your investing or your business or working career. Plus, you've eliminated this estate tax. And then to your point, the kids, even while you're still alive, you can partner with them to do deals. So it doesn't mean you're like completely passive. If you still want to do deals, you still can. You can do it with your kids. You can do it with yourself and your spouse, other partners. the trust can be this silent partner on the side to still help you get, deals that you want to do. Because every real estate investor typically, likes to continue to do deals, but you're not forced to do that. So that's a powerful way to do this. We have a 1.0 version that's very similar, but it doesn't do the estate tax elimination, but it's very much more flexible at the payout for you. But this works for businesses, real estate. It can save a failed 1031 exchange if you're working with us early. So Adrian, what questions or thoughts do you have on that? Or what questions do you think someone might have on controls or fees or legality that might be helpful if they're listening to this and want to learn more?
Right. The biggest obstacle that I face is with controls in terms of owners that imagine you've babied these properties and sacrificed and worked on them for 30, 40 years. That's your biggest thing. If I start distributing or go into a DST or estate planning, I lose control of the funds. I lose control of the property. So I would ask that's a common question is going to be, how do I maintain control? And then second, my question is, what's the process? So there's one you mentioned of triggering. It only triggers as you beneficiaries of the trust, obviously when the person passes. But alive, how are you able to eliminate the estate tax?
Yeah, so I'll cover the second one, then we'll go to the first one, right? So by nature, there's a tax code that we use for this 2.0 version that the way that it's structured through an irrevocable trust, and you sell it to the trust first, and the trust sells it to the ultimate buyer. It moves it outside of your taxable estate because the children are the beneficiaries of this trust is the best way to say it. And it's a note that cancels. This is without getting into like the proprietary nature of all this. Just know that real quick on the legal track record, 1,000+ transactions over 30, close to 30 years, all been through all the audits the tax attorney has, never had a change or finding any of the audits. Most of the deals done in California, and it's multiple thousands of transactions, by the way. So it's batting 1,000 there, but we're moving out of just ownership. So ownership, if you maintain like in a 1031, it's a continuity strategy. What that means is you're just maintaining ownership as you're trading these assets up and up and up into the same asset class. And by maintaining ownership, it maintains a stepped up basis, right? And so there's a tax law basically, or a law in the tax code that you can either have a stepped up basis or you can have it outside your taxable estate, but you can't have both, right? And so the way you get to the other one, we typically would say keep 30 million or 15 or 30 million, depending on where you think the exemptions are going to be, and then maybe the 1031 world, right? If you want to keep owning real estate. And then anything above and beyond that, let's get it outside the taxable estate, for the estate tax purposes. So so that's about what I would say on that. It does work. We can go through it more in detail, but that's essentially because you're moving from just an owner to a lender. Like so that changes the nature of, and then the ownership of the irrevocable trust is the children, and therefore it's outside of your taxable estate, but you're due the money over your lifetime, and you still have all that kind of the controls. You still have all of the decisions and approval for investments, whether you do your own deals or whether it's just passive into securities. And so back to the controls now. So you do have to give some control. So there's another saying that it's like the pain of discipline weighs ounces, but the pain of regret weighs tons, right? And so it's kind of this idea of control. Like you can maintain 100% control, but you're going to give up, control, if you will, of the 40% death tax within 9 months. Now, technically, you're dead at Israel, but your kids, right? So choose your heart or choose your control. The other side of it is, if you've ever done a 1031, Adrian, you've given up control for 45 to 180 days, right, under these rules. And so our company is kind of like a hybrid IRA and 1031 company where you're working with a third-party unrelated trustee. However, there's rules and controls in place. You as the lender have to approve of investments. Nothing moves out your approval or your signature. And you can go back into your own deals where you're running those deals by a joint venture partnership. We can work with a third-party financial advisor, right, of your own or other ones that we have on the team or in our strategic alliance. And collectively, this is a team aspect to say, how do we best pay back you and your spouse and maintain the compliance of it? In other words, without giving up some control, you're subject to huge tax. Another way to think about it is, let's say at a $10 million deal, 40% in tax, you can have 100% control of $6 million, or you can give up some control and have 10 million working for you. Although a lender is never concerned, Adrian, if they're not going to be paid, they're going to foreclose and take the asset. So you have all the rights and protections and controls of a lender to say to the trust, hey, trust, you're not paying me, or it's not performing. I'm going to therefore foreclose and take back all of the capital. And at that point, you'd be taxable on that amount. And so those are the key things to understand, that there's tons of controls in place, but we got to follow some of the guardrails. Otherwise, the tax law falls apart.
Sure. Well, that makes sense. Again, it goes back to you can figure this out when the owners are alive. However, once they've passed on, it becomes, I wouldn't say impossible, it becomes very difficult to go through this process, because there's multiple influences and factors in it. All I can encourage is to at least explore this when they're alive. It's part of it. It's going to happen. You worked hard for this, decades. At least get it set up and discuss it as a family.
Yeah.
You have to remember that the chances of, I wrote this down in my notes, is that when someone passes away, it's very rare that both husband and wife pass away together.
Right.
Usually right of survivorship. There's another thing. Let's say the wishes of one parent is different than the wishes of another. I mean, once one of them's gone, the other, without planning and family meetings and actually writing it down, you can actually orchestrate, be very detailed in the trust of how everything should be distributed. The right of survivor, they can change the trust without anyone's permission. I mean, even having plans in play of if one of the owners dies, that the beneficiaries and the heirs, then they get their 50%, that owner's 50% portion already. So that way there's offsetting forces, so that everything can't be liquidated, or if that makes sense.
It does.
Because if let's say the male dies before the female, generally speaking, mom can say, I'm done with this, and it gets liquidated without even getting to the heirs.
100%. And I think at the core of this, I'm just kind of thinking out loud here, is it's really having a mindset and a shift of identity from moving from, again, warrior king to sage, right? And so how do commercial real estate sages exit wise? Like, are you wanting to step into that sage role? Are you willing to give up some controls, give all the secrets away to the family, to the kids, to the grandkids, to give over the keys to the business and the real estate, and realize that, your time is coming to an end, and no longer having to be the king and the warrior, where you may want to stay in that stage because that's where you find your identity and your fulfillment and the fun and excitement. And instead of being like, okay, how do I in a sense delegate and relinquish this change of identity, and more so that my kids can do the same thing. They have an opportunity to be the warrior and the king in the next generation, because they weren't crushed by tax, because they were coached and mentored within the business, within this. And so it's an identity shift. So I really think the answer, or the title of our podcast here is How Do Commercial Real Estate Sages Exit Wise? And really leave a legacy that maintains momentum. And that's what we want to encourage you to do. If any of this has been valuable or you're interested and you want to get started, you can go to capitalgainstaxsolutions.com to get started on building a capital gains tax exit plan. And if you have a multifamily or a mobile home park property in Tennessee or California, you want to reach out to Adrian, because he can help you sell that and work closely with our team to give you this option for these DSTs, as well as 1031s. And sometimes, by the way, Adrian, it's a mix. Sometimes we have a partial 1031 exchange and a partial strategy. We do that all the time.
Right.
And I think I'll end with this last deal story. It was a client, they had a multifamily property in Sacramento, about a $2.5 million deal. They did a 1031 out of Manhattan Beach, a married couple, 2 kids, had them a little bit later in life. And they were twin daughters. And they were thinking like, you know what? We really want to maximize our time between 10 and 18 before the kids are off to college. And the property was doing well, good tenants, great location, all those things. But they just kept finding that Warren, the husband, he was spending time at the property so much, right? Even though he had good property management, it was always something pulling him back to the property. And he'd spend a weekend, or a couple days there every month, and it's pulling him away. And he's going, what are we trading here? And they go, what's priceless? Well, what's priceless is our time with our daughters. What's profitable is the property. But why are we making a bad trade? Why are we trading what's priceless for what's profitable? In other words, they had the toilets, the trash, the termites, the tenants, versus their 2 twin daughters. And so we presented a plan for them to exit well, to pay off some of the debt, defer their tax, and to diversify the wealth. But the biggest impact for them was they got their time back. Yes. And he said it took about 3 to 6 months. Then all of a sudden he looked up, he's like, whoa, I didn't realize the weight that was on my shoulders on these things. And wow, this is so much better than having this property that's pulling me away from my kids and my wife, right? And being able to do what we want to do. And so I just want to encourage everyone with this. Please take action for what we talked about today. Adrian, any last words, and where can people find you if they want to reach out to you?
Yeah, I do. I do have one last thought, is that you talk about exiting as a sage. You're an owner, let's say for 30 to 50 years, some of it you've just held long-term, but many of them you've accumulated via a 1031 exchange. The reason you did a 1031 exchange was because you wanted to not pay taxes to the government. In fact, most of these owners want the government out of their lives, not paying taxes, no rent control, etc. Yet if you don't plan properly, or if you take the mindset of my heirs can deal with it, forget it, I'm leaving them plenty of money, you're about to make them pay taxes on everything you stood against and everything you sacrificed for. And you go from being a sage to a curse, believe it or not.
Yeah.
Because of everything they're going to have to deal with. And that it'll take 90% of their time working through the scenario.
Yeah. So take action, plan, prepare, talk with me and Adrian, sit down, bring your CP in to vet all of what we're talking about, and basically, execute right on and get the momentum on your side. Again, capitalgainstaxsolutions.com for me. Adrian, where can they find you?
PCGcommercial.com, PCGcommercial.com.
Awesome. I want to thank everyone for listening or watching another episode. We're on YouTube on the Capital Gains Tax Solutions YouTube channel, as well as the Build It to Billions podcast and YouTube channel. And we're on the journey with you, the multifamily, the commercial real estate, the business owner who's trying to scale from millions to billions so they can give more all the way to make a bigger impact. And we want to encourage you to take action today. I'm Brett Swarts. He's Adrian Del Real. I appreciate you listening, and we'll talk to you all again real soon. Bye now.
You have just listened to another information-packed episode of Capital Gains Tax Solutions with Brett Swarts. We hope you enjoyed today's show and found it helpful. Visit capitalgainstaxsolutions.com to access the show notes and to access more resources. Don't forget to leave a review and join us again next time.